Time now for some business news, and the new formula governing loan pricing formula agreed on by banks and the Central Bank of Kenya is now in effect. All 37 commercial banks will now be required to use the uniform formula that becomes effective today. The Central Bank says that the new formula change will make lending fairer, more transparent and more responsive to market conditions. Our reporter Jasmine Wamboi explains what this means for borrowers.
All 37 commercial banks have today begun using a new uniform pricing formula for loans issued to Kenyan borrowers. The change introduces a single base rate for the entire banking sector, drawn either from the commercial bank rate now at 9.25% or the interbank market. From that base, each bank will add its operating costs and a customer-specific risk premium.
Each and every customer needs to be able to know how does a bank arrive at 16%, 17%, 18% on my loan.
This new system demands more transparency, as banks must now reveal how they price their loans. This lending rates and fees information will be published on the Total Cost of Credit website, hosted online by the Kenya Bankers Association and the Central Bank. Not only will this intensify competition on the lender's end, it will also make it easier for customers to compare their options on the basis of lower interest rates.
As a customer, you have now the opportunity to be able to improve on your risk profile and then now move from a higher rate that you are on currently and progressively be able to be afforded lower rates.
This means that borrowers with stronger credit scores will pay lower interest rates. The new system applies only to Kenya shilling loans issued by commercial banks, with the exclusion of foreign currency loans and fixed rate facilities that were agreed upon earlier. Similarly, loans from SACCOs and microfinance institutions remain unaffected. All new loans will follow the new formula immediately.
Now, for existing loans, we still have a window up to 1st of March 2026. That's when now all the existing loans are supposed to have moved.
The Central Bank says the framework aligns the country with international practices and strengthens monetary policy by relying on real market data. The banking industry says that this new loan pricing formula is going to be very good for you, because the cost of your loans is now going to be directly tied to your borrowing habits. Jasmine Wamboi, Citizen TV, Nairobi.